We remain cautiously optimistic coming into 2026. For the majority part of 2025, we've been very optimistic, and I think going into 2026, investors should be looking forward to another pretty good year. We have price target at 90 for MSCI China at the end of 2026 and 27,500 for Hang Seng Index. So that implies another 4 to 5% upside at the index level. But I think single stocks and thematic opportunities, the alpha-seeking opportunities would be the way to invest in China this year. And we're expecting another 6 to 7% of earnings growth for the entire MSCI China Index for this year. And if we start to see earlier launch of major stimulus policies from Beijing and maybe another DeepSeek moment with tech innovation, then we could be expecting even much higher returns at the index level.
Now, the upside that you're expecting for the Chinese and the Hong Kong markets, not quite some of the forecasts that I'm seeing at other banks, calling for 20 or 30%. Are you able to put that into perspective for us?
Yes, I think that's because we're expecting a relatively stable valuation for the entire market, because the China equity market actually had already achieved a more than 30% of valuation re-rating in 2025, which is a major achievement, and we really want to applaud for that. So for this year, we think it's a year of stabilization rather than another leg of re-rating opportunity. And frankly speaking, we're not only expecting this for Chinese market. If you look at our Morgan Stanley forecast across the globe, for the US market, for Japan, for Europe, actually we are expecting flat or even slightly lower valuation across the board. So for China, actually we're expecting flat, which means our expectation for the valuation and for the stabilization of the valuation for China is slightly better than for the other markets.
Are you also able to detail your bull and bear case, because the spread is very wide?
Indeed. So our bull case actually suggests another more than 20% upside for China market. And that actually comes from a slightly better earnings growth forecast, in the sense that what I was trying to explain to you earlier, if we would be receiving bigger and stronger stimulus package from Beijing. And of course, from the valuation side, now MSCI China is trading around 12 to 13 times forward PE, right? For that to go much higher, we probably need another regime shift in terms of how global investors perceive Chinese equities investability. And that would be very much, I think, accomplished through another potentially DeepSeek moment. But we will have to wait and see.
As you've highlighted previously, a shift from valuation expansion to earnings growth. What is the key for this shift, and how do we pick stocks?
I think the key thing to remember is to stand by the national growth strategy, which was clearly laid out in the 5-year growth plan, which was disclosed in the fourth plenary towards the end of last year. This means we should stick to the high-tech sector, the innovation sectors such as smart manufacturing and biotech, automation, robotics, and all these. At the same time, we think insurance is a good sector to go, because insurance sector offers very decent dividend yield, around 3 to 5%, which is quite attractive as the Fed bond yield is coming down. But at the same time, insurance as a sector also offers very good correlation when the market is going up generally.
Are you able to share with us your Hong Kong and China focus lists?
Yes, we actually have a quite strong focus on the tech and innovation names. For example, we have Alibaba and Tencent as two key AI players in our focus list, and we want to stick to the champions, the big companies with strong track record, with strong commitment in terms of capex expansion in the next few years in the space. And we also have names in automation and robotics. And for example, about insurance, we recently added Ping An into our focus list.
So do you prefer the bigger names, the platform companies, over picks and shovels? Because we're seeing many of the AI names come to market here in Hong Kong, lesser known, a little bit smaller, a little bit younger in companies. Is it picks and shovels or platform companies?
We don't necessarily discriminate against in terms of size or a duration or age of the companies, but I think we do prefer to look at companies above a certain size, because we actually help a lot of global institutional investors, and companies above a certain size, I think, would offer more liquidity and transaction opportunities. That being said, I think what we really care about is earnings visibility. We talked about how much the market has already gone up in 25. So beyond this level, I think the quality of earnings and certainty of earnings will be the next leg to go up. So companies with good earnings track record and with very clear and strong guidance into the next few quarters of 26, those are the things we are looking for, regardless of the size of the company.
What about dividend plays?
Yes, we care about that. I think that's another allocation preference we have for an overall portfolio construction. Because I think 26, we would also be expecting some uncertainty from time to time. Even at the beginning of the year, I think we've been having strong start, as you said, in both the Asia market and Hong Kong market. But on a global basis, we are seeing uncertainties arising here and there as well, right? So to help us navigate through these uncertainties and temporary, I would say, volatility spike, allocation to dividend yield plays would be a good way to go. I mentioned earlier, insurance sector would be a good way to look for opportunities, but at the same time, I think some high quality green utility names would also offer those opportunities.
What about policy plays as the Chinese market gets ready for the National People's Congress? We'll get more about what is the full-year target for growth, GDP in China, also the growth priorities for the economy. How does that fit into your investment plans?
Yes. So I think the policy plays, we need to shift our mindset. Historically, when people think about China policy plays, people think about cyclical plays in terms of construction names, in terms of property names, and in terms of infrastructure spending expansion. But I think over the last several years, what we have observed as a clear pattern is that the Beijing policymakers are putting more and more priority and emphasis on high-tech competition, on innovation. So this is why we continue to say that to stick to these sectors, these thematic opportunities. Of course, if as we approach February, March, and if we start to hear more opportunities around, for example, mortgage rate subsidy packages or bigger, stronger consumer stimulus packages, then we can consider to look at some of these opportunities as well. But now I think it's still a little bit too early, a little bit too premature to go back and re-embrace these sectors.
Can you speak to global interest in the Chinese markets? Is it there?
It's absolutely there. In 25, we are seeing the global institutional inflow into China equity market turning net positive for the first time, I would say, in 3 years. So last year, we saw a net $14 billion of inflow from global investors compared to a net $17 billion of outflow in 2024. So that's a major shift. And given that, I think, as I said, we are still expecting further upside from the China market, and the valuation is very reasonable compared to other global peers, the Japan market, US market, European market, and also that the current positioning by global investors in Chinese stocks is still very much underweighted. So I think the room for them to further increase their allocation, particularly from a global diversification perspective, is very good.